So as expected, the Federal Reserve finally cut interest rates by 0.5% last week. But if you or anyone you know is in the market to buy a home, then you may have noticed that mortgage rates actually went up slightly. So how is that even possible? Well, in today's video, I'm going to share with you why that took place, let you know what to expect mortgage rates to do over the coming months, and at the end of this video, I'll let you know how this is likely to impact home prices here in the Frisco, Texas area. So without further delay, let's jump right into it. Hi, this is Andrew with the Andrew Smith team, eXp Realty here in Frisco, Texas. And, the Fed dropping rates, I can't say that was much of a surprise. It had been expected for a while now. They'd started talking about it all the way back in July. And the big question became, how much were rates going to be cut? And why now? So back in August, the Federal Reserve Committee met in Jackson Hole, Wyoming. And as a result of those meetings, Jerome Powell made the statement, the time has come for policy to adjust. Now, the reason Chairman Powell made those statements is the Federal Reserve's primary objective is to keep a control on costs and also to work on employment. So you have weaker than expected jobs numbers have come out. The unemployment rate has been ticking up slightly, and inflation continues to cool. It's moving down closer to the Fed's ideal target. So with that in mind, the economic conditions were right for a change to be made. But what many people don't realize is the interest rate that's set by the Federal Reserve, the federal funds rate as it's known, is not directly tied to mortgage rates. And I know that can get confusing, but in simple terms, the federal funds rate impacts car loans, credit card loans, any other type of consumer debt, home equity lines of credit, things like that. So the fact that they cut those rates is really, really important. It is going to be beneficial. So as stated here by Bankrate, the Federal Reserve doesn't determine fixed mortgage rates, but its policy decisions do influence overall borrowing costs. And what I'd like to point out here is that when you're looking at mortgage rates are actually tied to the 10-year Treasury bond. And what happens with that 10-year Treasury bond is a better indication of what happens to mortgage rates. Let me show you here. So this is going back over the last 50 years, and you can see the Treasury yield, the 10-year Treasury bond is the blue line, and 30-year mortgage rates are the green line. And you can see how those two lines mirror one another. They track. So if you want to get an idea of what's going on with mortgage rates, just simply look at what the 10-year Treasury yield is, how that changes on a daily basis. And that's going to give you an idea of what's happening with mortgage rates. Now, you may notice that there's a difference between those two lines, and the difference between those two lines is what is known as the spread. And if you go back historically, the spread has been 1.75% or 1.75%. So what's the spread? It's basically an indication or a gauge of fear or risk in the overall marketplace. So if investors get an idea that there's more uncertainty, then you find that spread increases. Less uncertainty or more stability, if you like, and you'll find that spread comes closer together. So again, the average over the last 50 years has been 1.75. But if we look right here, over the last year and a half, you can see that the spread has fallen. The spread was 2.76 all the way back in January of 2023. There was a great deal of fear, uncertainty in the market at that time. And so that spread has fallen back down. It's fallen to 2.375. Still well above the historical average, but it's moving in the right direction. And that is really important because even if we don't see massive changes in the 10-year Treasury yield, we could still see mortgage rates come down. And what influences that spread is not necessarily the actions of the Federal Reserve, but it's the comments that they make after their federal funds meeting. So this last time, they also indicated that they would continue cutting rates. I'll touch on that in a minute. They also talked about the fact that there was some uncertainty in the overall economy going forward. And those are the comments that actually caused mortgage rates to tick up slightly after the Fed cut its rate. But it is expected, and I'll go into that in more detail shortly, that mortgage rates will continue to come down. Now, this makes a huge difference. So for example, as Rick Sharga mentions here, if the gap between the yield on the 10-year Treasury and the 30-year fixed rate mortgage just went back to that normal level of 1.75, today we'd be seeing mortgage rates between 5.2 and 5.6. And I think you'll agree, it's a lot easier to stomach those rates than it is rates in the mid upper sixes or even sevens as it was just about a year ago. Now, the other thing to keep in mind here, and the reason we're starting to see some additional forecasts come out on where mortgage rates are going to go, is the Fed made it clear that this wasn't a one-time rate cut. This was just the beginning. Lawrence Yun, who's the chief economist at the National Association of Realtors, noted that the Federal Reserve's half-point rate cut is the beginning of 6 to 8 rounds of further rate cuts that will go well into 2025. Next one won't occur until after the election, and the justification is cooling inflation in recent months and lighter job gains, which is what I mentioned right at the beginning. But overall, though, we can see that rates have continued to come down. They continue to tumble when you look at these weekly averages. See, they started at 6.95% back in July, and they're just right around 6.1, 6.15 as of today when I'm recording this. And this makes them, as you all know, it makes a massive difference in what your monthly payment is likely to be. So right here, this goes to show on a $400,000 loan how much things have changed just from April until now. So the payment on a $400,000 loan in April, when mortgage rates were 7.5%, was $2,800 a month. Now at 6.15%, they're actually $2,400 a month. So just that change has resulted in a savings of $365 a month, which makes a big difference, especially if inflation overall continues to come down and we start to see prices in some other areas ease as well. Now, where do mortgage rates go from here? Well, that's the magic question, isn't it? I mean, right now, it's anybody's guess. Nobody has been successful at accurately predicting mortgage rates. If we go back and look at where the projections were previously, they weren't even close to where we are right now. So there's definitely some uncertainty out there. And I expect, like what we've seen over the past week or so, it's going to be a bumpy ride. They're going to be up a bit one day, down a bit one day, up a bit one day, down a bit one day. But the overall trend appears to be declining, which is great news for buyers. But it actually starts to beg the question is, as a buyer, what should you do? And what is it actually going to take for buyers to actually come back into the market? Now, should you wait? Now, waiting until next spring or summer is definitely going to give you more inventory to choose from as inventory continues to grow, but you're likely going to be up against much greater competition since you are in the peak busy season. And I'd like to point out, I don't know if you saw it, and I'm going to put a link down below to my September monthly market report as I go into this in much more detail. But a study was done recently, or survey, not really a study, and it was asking potential home buyers, what's kept you out of the market? 72% of all of those surveyed indicated that they had put their plans to buy on hold due to affordability. mortgage rates were too high. So what does that mean going forward? Where is this likely to put us? Well, in that monthly market report I just mentioned, I also went into more detail on why haven't home prices fallen? What's the deal with that? And it's basically supply and demand. Right now here in Frisco, at least, the bulk of our supply has come from new construction. Anybody in this area knows we have new construction, new communities everywhere. And to be honest with you, that's been the saving grace in this market. If you look at other markets, look at Northern California, San Jose, for instance, homes are already ridiculously expensive, but there's very little new construction. So as a result, those home prices have been going up. They've been going up at a substantial pace just due to the fact that there hasn't been any supply relative to demand. And even though 72% of buyers put their home buying plans on hold, the remaining buyers there are still enough to keep an imbalance between supply and demand. Has it gotten better? Yes, it's absolutely gotten better, but it isn't enough to make a huge dent in home prices. The other aspect, as I just mentioned, the supply is coming from new construction, but what about resale? Well, the problem is, from a resale perspective, if you've got someone that owns a home with a mortgage rate around 3%, 3.5%, why are they going to sell? And the answer is they're not. It's what's known as the lock-in effect. So recently, those sellers, those homeowners were asked, what would it take in order for you to make the move that you'd been thinking about but delaying? 35% said a rate less than 6%. 30% said they'd need to see a rate lower than 5%. For those looking for a rate less than 4 or less than 3, I think we can just not even worry about those right now, because I don't think we're going to be seeing those rates anywhere near soon. But here you've got 35% and 30%. Over a third of sellers are saying they need to see rates come down in order for them to make a move. Now, likewise, let's look at the buy side. More than half of home buyers said they would return to the market if rates fell below 6. Only 35% of sellers said they'd return to the market and put their home up for sale if rates fell below 6. But 52% of buyers are saying they would return to the market if rates fell below 6. And I think the idea of seeing rates below 6 is a lot closer than we think it is right now. It's probably not too far away at all. That just tells you that there is still likely to be an imbalance between supply and demand. So what do you think that means for home prices? Again, could it change? Yes, but there's absolutely nothing right now anywhere in any of this data to suggest that home prices are going to decline. Are they going to keep going up at a ridiculous rate? No, I don't think we're going to see that at all. But the idea that they're going to fall substantially, based on what? It's going to have to be something else that happens that we don't know about, that's not in the data right now. And maybe you've got a gut feeling that's going to happen, in which case, that's great. If I see something, I'll definitely let you know the minute I see it, but there's just nothing there currently right now. The director and senior economist at Wells Fargo, he said lower financing costs will likely boost demand by pulling affordability crunch buyers off the sidelines. And what he's saying right there basically ties into what I was just referencing with regards to supply and demand. Unless we see something drastically change, you are going to see home prices to continue to increase over the next 12, 24 months. Is that absolutely true? I don't know. I don't have a crystal ball. I can't tell you exactly, but all I can tell you is that all of the data that I'm looking at, there's nothing anywhere to suggest a change is on the horizon. Now, one of the best ways for you to track that yourself is through my weekly market report. If you haven't signed up for it, I invite you to do so. There's a QR code up on the screen where you can sign up for that. I've also got a link for it in the description below. And in that weekly market report, it shows you all the latest pricing trends. It shows you whether inventory in your market is growing, holding steady, or declining. It's going to show you how many sellers are still making price reductions on their property. So it's a great way to gauge exactly what's going on in the market. And the good news is it's available for every city or zip code in the country. That QR code is going to take you to the Frisco report. But from that report, you can type in any city or zip code you want, and you will get the latest data specific to that market. So hopefully this provides you some value, hopefully provides some information on what exactly is going on. If it does, or if it has, I invite you to hit that thumbs up and go ahead and subscribe to this channel, because I release new videos each and every week with market updates, what's going on with the latest trends, just like this, as well as showcasing some of the most popular neighborhoods and properties in and around the Frisco, Texas area. And if you've got additional questions, need additional information, or just want to talk things through, I invite you to schedule a free 30-minute consultation. No pressure whatsoever. It's just you fire away, you ask questions. Let's talk through your specific situation, and let me share some additional insights and give you the information that you need to make the best decision for you and your family. Now, thank you for spending a few minutes with me today, and don't go anywhere, because I've got another video coming up for you right now.